Okay, good day guys. So on today's video, I'll be showing you guys on how to get your daily setups and also know when to leave the market, when to stop taking trades. So, and for every trade that I normally take, I always follow the trend. So this kind of pattern is just a kind of trend based pattern. So you always have to follow the trend when using this pattern. So let's say price is moving in a bullish direction, or let's just say rather price is moving in a bearish direction. Say price was moving in a bearish direction, and then suddenly you see a market structure shift. So one thing you should always notice that after this market structure shift, you should always expect price to retest twice before you expect any kind of reversal. When I mean retest twice, is that after the market structure shift. So let me just draw the market structure shift first. So after the market structure shift here, after the market structure shift, what you expect price to do first is to go back to retest on a breaker or an order block. So you see price now push to the upside. So now this is the first retest. So after this first retest, you expect price now to come back again to retest on a breaker block or an order block for the second retest. So now you see price now do this second retest. So immediately after this second retest, you should always avoid taking any trades, because there are two things price can do from this point. Is either price will decide to continue on this trend, ignoring any order block or breaker block from this low. Price just continue going in that particular trend. You just see price going in that particular trend, or you see price now from this region, price just decide to clear out all sell side liquidity. So these are the two things you can always expect price to do after this second retest. So when following the trend, after when you see price do the first retest and the second retest, you should always avoid taking any trade. What you should wait for is for areas where price will do a market structure shift again. So let's say price now decide now to continue on this trend. Say price decide to continue on this trend now after the second retest. You see price will just ignore any breaker block or any other block. It will just start moving in that direction. So what you should wait for next is for another market structure shift, an area where price now will break below that previous low. So now this will be the new market structure shift here. So all this I will be showing you on the chart. So this will be the new market structure shift now. So what you expect price to do now from this point is to do this first retest. So now this is the first retest, first pullback after the market structure shift. So now after the first pullback, you also expect price to go back to a breaker block or an order block for the second pullback. So now this is the second pullback after the market structure shift. So you can also expect two things from this kind of pattern. You can also expect price to keep going lower, just like that, creating multiple breaker structure. And note, this kind of breaker structures, we always ignore any breaker block or any other block that is being formed. Price just continue going lower like that. So this is the first thing you should always expect after the second pullback. And you can also expect this again. Price just decide to continue on that direction again. So these are the two things you should always expect after the second pullback. So I'll be showing you this kind of pattern on the chart, and also how you can know when to exit the trade. So now, okay, from here now, you can see this first break of structure. So let me draw that out. This first break of structure. So one thing you should always notice that this particular break of structures, you can always get them on different time frame. You can get them on the 15-minute time frame, the 30-minute time frame. So it all depends on the kind of time frame you choose, and for you to be able to use this tool, you must always know the current trend of the market. So for you to know the current trend of the market, you can start making your analysis from the higher time frame just to know the trend. Then you go to lower time frame looking for trades in that direction of the trend. So this is the first break of structure. Second break of structure. See, price was just doing break of structures. Break of structures. So this region here was the last break of structure price did. That was the last break of structure price did. And from here you can see that this region here was the previous low. And price now broke below that previous low, creating this market structure shift. So that will automatically tell you the uptrend is not valid anymore and price has moved to a downtrend. So now this is the market structure shift. This is the first pullback which retested on the order block after the market structure shift. So that is the first pullback, and that first pullback now resulted to this break of structure. So after the break of structure, now you see price now pull back again to retest on an order block. Note this is on Euro USD on the 50-minute time frame. So now price retest on that order block, this order block here, indicating the second pullback. So after this second pullback, you should always avoid taking any trade, because price, you might see a reversal, or you might see price just keep going lower. So now price did that second pullback. Then from this region here, you can see it did the third pullback. Just immediately after the second pullback, it did the third pullback. So now most people now will be taking their trades using this order block here. Let me just draw that out. So most people now will be taking trades. They will be looking for sell with this order block. So you see why more recently I said you should always avoid taking trades after the second pullback, because most people now, they will be waiting for price to retest on that order block, and they will be looking for sales, but only for them to be stopped out, and you see price now move to the opposite direction. So now that was the previous high created, and you see price now broke above it, creating a market structure shift again, So after the market structure shift, now you see price now come for this order block at that bottom there. Price came for that order block, retested on it, took out this previous high, indicating a break of structure. So now this is the first pullback after the market structure shift. That's the first pullback after the market structure shift. So now you see price now come again at this bottom here, came for the order block at this bottom here. Price came for the order block at this bottom. So price came for that OB at the bottom, took out this previous high again, indicating a break of structure. Now this is the second pullback that retested on the OB. This is the first pullback that retested on the OB after the market structure shift. This is the second pullback that retested on another OB after the market structure shift. So after the second pullback, you should always avoid taking any trades. So now you see, now if you follow this pattern I gave here, now I told you that two things price will do. Either it will keep going in that particular direction, just like that, or it will just move to the opposite direction, taking out all sell side liquidity. So two things were to happen at this point. Either price will come back from this region to take out all sell side liquidity, or it will just keep going in that particular trend. But you see now, from this break of structure, now you see price kept on going in that particular direction. After this break of structure, now it did another pullback again, came to this previous high, did the pullback again, came to this previous high, did another pullback again. At this point, see, it kept on going in that particular trend, did another break of structure again. So now this particular trade here, I didn't take this trade, I just did the analysis after price has already triggered. So I didn't take this trade from the entry. So now the reason why this trade was valid was that there was a breaker block here, and the breaker now it grabbed this sell side liquidity. If you go to the 5 minute time frame, you will see there was a liquidity there. So the breaker block now grabbed that sell side liquidity. So grab that sell side liquidity, making the breaker block valid. That's why I see price was moving in the bullish direction, and I'm expecting it now to take out this previous high here, creating another break of structure. So now if price should create a break of structure here, if price should create a break of structure here, if price should create a break of structure here, this region, if I should create a break of structure there, this region now will be the previous low. If price should create a break of structure, that will be the previous low. So now if price should move from this direction, let's say price move from this direction now, created a break of structure, came down again. So now it has already created a market structure shift, meaning price has broke below this previous low. So this will turn to the market structure shift. That's if price breaks below. So now this will turn to a market structure shift. Then now you expect price now to retest back again. So after the first pullback after the market structure shift, you can take trades using this first pullback. Then you can either aim for this previous low, or you can use a 1:5 risk to reward ratio. Then once price hit your take profit, you wait again for price to go back to do the second pullback, which will retest on a breaker block or an order block. So this will be the second pullback. You can still aim for the previous low, or you use 1:5 risk to reward ratio. So once price hits the take profit again, you stop taking any trades, because price has done the first pullback and the second pullback. So there are two things price can do from here. Either it will keep going lower, you see price keep going lower just like that, or it will just go and clear out the whole buy side liquidity. So it's mostly advisable to stop taking trades after second pullback. So now this downtrend hasn't been confirmed yet, so what I am waiting for now is for price to do a market structure shift from this point. So the only thing I'm waiting for now is a market structure shift from this region. So now I'm just following this trend, just observing what price is doing each day until I see an area where price will create a market structure shift. So I'll just use that to take sales. So let me give you another scenario again. Let me give you another scenario again. See. Okay, let me use here for example. See this market structure shift here. The market structure shift at that bottom here. And after the market structure shift, you can see the first pullback after the market structure shift. The first pullback, the second pullback after the market structure shift. And you see after the second pullback, price kept on following that particular trend, kept on going lower, like that. So once you see price now do the second pullback, you should always ignore those lower lows price will be doing, or higher highs price will be doing. You just have to wait for an area where price will do a market structure shift again, because areas where price do a market structure shift will give you a, like, how will I put it, a good confirmation that okay, this trend is going to the opposite direction. But if you should decide to follow that particular trend after second pullback, you might be taken out, or you might be used as a liquidity grab. So it's more advisable to wait for the market structure shift. Even on lower time frames here, you can clearly see this one now. You can clearly see this. After this market structure shift now, you see the first break of structure here, very tiny. First break of structure, second break of structure, meaning this is the first pullback, second pullback, then this is the third pullback. So now you see, immediately after the third pullback, now price did market structure shift. After the market structure shift, you see this first pullback again. After the first pullback, you see this second pullback again. After the second pullback, what did you notice? Price reverse to the opposite direction, taking out the buy side liquidity. So you see why I told you it's more advisable to take trades with just the first and the second pullback. So now let me look for another scenario again. Let me look for another scenario. Okay, let me delete this from the screen. Okay, now from here is that market structure shift. Okay, from here now, first market structure shift. Market structure shift at that point. It's okay. I think there's no it's not market structure shift. I think. Okay, there was a market structure shift here. First market structure shift. So now this is the first pullback after the market structure shift. After that first pullback, now this is the second pullback again after the market structure shift. First pullback, the second pullback after the market structure shift. So after the second pullback, what did you notice? Price now broke above second pullback, creating a market structure shift again. So you see, it's more advisable to take trade just with the first and the second pullback. See, after the second pullback, price created this market structure shift again. After the market structure shift, what did you notice? The first pullback again that retested on an order block after the market structure shift. So after that, it created a break of structure. You see the second pullback again. So after the second pullback, you should avoid taking any trades. Just wait for price to create another market structure shift again to be on the safer side. So now you see break of structures, another break of structure here, until price came now and broke this previous low, creating a market structure shift again. So now just ignore all these tiny movements here. What you are following now is the major break of structure. Inside the break of structure, there's also another break of structure. So this one now moved to this point, came down to this region, came here, came down, and back to this region here. So now if you follow this pattern, now you see this was the previous low, and now price broke below that previous low. Creating market structure shift. Now after the market structure shift, what do you notice? First pullback now resulted to this break of structure here. Second pullback resulted to this break of structure here. Then you see the third pullback now. Third pullback resulted to this break of structure. After the third pullback, what did you notice? Another market structure shift again. Price broke above this region here, creating another market structure shift again at this point. So you can always use this pattern when taking trades. Follow this pattern when taking trades. So this is all for today. So you can also do this back testing on other pairs. You can do this back testing on gold. You can do it on BTC USD. I guess the strategy will be accurate on those pairs too. So this is all for today. So let's move to the next one. So next I'll be talking about risk management, and we all know risk management play a very vital role in trading. And even with the best strategy, if you don't have a good risk management, you still end up losing your trades. So it's more advisable to follow risk management. So I'll be talking little on that because I've said more about risk management on my previous video. So risk management, like me, the way I take my trades, I always try to use a very good risk management. I don't put more stress on my account. I always use the proper lot size for my trading balance. The only times I use a very big lot size is, let's say I'm using a different account from my main account. So let's say I'm going to risk, I have just $30 I'm going to risk, like free $30 I'm going to risk. I can just deposit that $30 on a separate account. I don't deposit that on my main account. I'll deposit that on a separate account. Or let's say I have $20 I want to risk. I'll deposit that on a separate account. Then I can just like decide to just increase my leverage, because on Xness you can increase your leverage. So I'll just increase my leverage on Xness. Now when I know the $30, even though the $30 blows, it doesn't concern me. That's the only way you can take this kind of risk. So I know even though the $30 blows, it doesn't concern me. So I'll just increase my leverage and use a lot size that will be suitable to cover up the stop loss I'm going to use. Then I'll just wait for my perfect trades, or I will look for my A setups. Then I'll use that to take the trade. Just the trade most times is just one shot. Once you miss that shot, the $30 will blow. So the trade is just one shot. But in cases where I know, okay, I don't have $30 to risk, I know this $30 is the only $30 I have, I need to manage it. So that's when you have to use risk management. So now out of that $30 now, you are not, if you are trading pairs like Euro USD or GBP USD, you are not supposed to be using lot size like 0.05 or 0.1 or 0.2 or 0, sorry, or 0.2. You should be using lot size like 0.01 or 0.02 in order for you to be able to grow that account. Because if you use a 0.01 lot size and you use a 0.02 lot size, you can be taking trades using like 1:5 or 1:3. That's if you are risking, even though you are risking $2 for one trade, or you are risking $3 for one trade, you know you are earning 5 times that amount, or you are earning 3 times that amount. So it's a step by step process. The more you grow your account, the more you can be able to increase those lot size. And one thing you should also notice that when you are taking those trades, if you're already running on profit, if you open one position and you are already running on profits, and your trade is, let's say, 1:5 risk reward ratio, don't open more positions. Just wait for that trade to run until it hits your take profit or it hits your stop loss. Because if you should decide to add more position, price can just decide to go back to the entry again to retest, and that way it can stop you out, or it might hit your stop loss, so you'll be on a bigger loss for that day. So always take all your positions from the beginning. Don't add more position to a winning trade or a losing trade. Don't try to reverse trade. When I mean reverse trade, is that you took a trade, the trade took you out. Like, you know that entry was supposed to be valid, but price ignored the entry, violated you, and took you out. Or you should always take it like that. Don't try to force a way into the market back and say, okay, I want to recover the money that they took from me. If you do that, you most times you might end up losing more. So once you take those losses, always wait for another setup. Wait for a perfect setup, because it's better to lose a trade that you know, okay, I know the reason why I lost this trade, than to lose a trade that you don't have any idea why you lost. You just lost for no reason. So it's much better to learn from your mistake. When you take a trade and you know this trade was supposed to follow this my strategy, and the price took you out, you know you have to look back to the chart again, look at that region, and you'll be able to know the reason why you lost that trade, rather than just opening the chart and taking random setups. That way, even though you lose the trade, you won't know the reason why you lose, and you will end up making that the same mistake multiple times again, losing money in your account. So always be patient. Don't try to revenge trade. And another thing you should know is that don't overstress your account. Use the accurate lot size for your trading balance. Use the accurate lot size for your trading balance. Like me now, if I'm trading pairs like Euro USD now, I always use my stop loss is not more than 20 pips. Yes, I use 20 pips stop loss. That is minimum. Sorry, the minimum stop loss I use on Euro USD is 20 pips stop loss. So if I'm using a 20 pips stop loss on Euro USD and my account is at, let's say, 100,000 naira, I always try to use the lot size that is suitable for that trading balance. You can even go to your like online, you can use your AI or your chat GPT. You can simply type to it that okay, my trading balance is 100,000 naira. I'm using a 20 pips stop loss for that 100 naira, and I don't want to risk more than 10,000 naira or 15,000 naira for each trade. What is the accurate lot size for me to use? Just type it to ChatGPT like that. That's what I normally do. Type it to ChatGPT like that, or you type it to Meta AI or any other AI, and it will give you the accurate lot size to use. And once you input that lot size for that 20 pip stop loss, it will give you the accurate amount you wish to risk for that particular trade. So this is what you should always know. Try to learn how to calculate the accurate stop loss and the accurate lot size to use for your trade, because if you don't use most times if you don't use the accurate stop loss, let's say you are taking a trade now and on a normal the price is supposed to violate that setup, or let's say the setup is not supposed to be valid, and you are using stop loss like 50 pips or 60 pips stop loss now, and price eventually reverse now, hit your stop loss, you will be on a bigger loss. But if you are confident in that trade and you know okay, this trade follows my strategy, you are using 20 pips stop loss minimum, or you are using 30 pips stop loss 30 pips stop loss maximum, that one, even though price should take you out, you know okay, price took me out, the setup is no longer valid again, and I didn't lose that much, rather than the one, you know the setup is not valid and you lose up to 60 pips stop loss. So you should always know this thing too. So a very this is one of the things I normally do when taking my trade. So you can also apply this too, and I'm sure it will also help you in your trading journey too. And with time, you'll be able to get used to it and master it. So that's all for today. Thank you.